Pivot is the term of the last week. Obviously, post-Powell. That's what many suggested that the Fed chair did, and the Fed itself pivoted. I feel like we got a little bit of one today from Morgan Stanley's Mike Wilson, who says, quote, with Powell not pushing back on the easing in financial conditions, equities appear to have the green light to ramp higher. We could be entering a sweet spot that supports this rotation if nominal growth accelerates. He's talking about a rotation. Small caps, cyclicals, lower quality stocks could be the beneficiaries, much like Liz was talking about the rotation that she's seen as well. What do you make of that?
Yeah, it was kind of interesting. I read that note as well, and it does seem like a pivot by Mike. So, look, he's a good thinker, and some would argue that it was stubborn for a long time, but really the rotation, the broadening of the market only occurred in the last couple of months, really in November. So I don't know how much he overstayed his welcome. The pivot, I'd say, was a more aggressive pivot by the market than by Powell. And since then, we've had in succession, whether it's Austin Goolsbee today or on Friday, the Fed has come out, the FOMC members have come out and tried to throw cold water on market expectations for an easing as soon as March. Nonetheless, the market continues to act strong, and it doesn't matter right now when they ease, because the market will discount that. All that matters is that the table is set for them easing. So you can say, hey, it's going to be March, it could be June, it could be September. It just doesn't matter. The point is the tightening is over and that the easing is going to begin. What does matter, however, is what the next quarterly earnings are and company guidance. And that will be the big question. I still think it may be muted, but what I don't know, and I said this on Friday when I called in, is will the market see through it? Everything about the market in the last 3 years tells you that they will see through it. So you could see actually valuations continue to increase. And by that would happen if earnings don't follow suit.
Yeah, how about this, Jason Snipe? David Kostin, Goldman Sachs, raises his 12-month target for the S&P, and significantly so, to 5,100 from 47. Decelerating inflation, Fed easing, real yields low, support PE multiples greater than 19 times, encouraging economic data, upside risks existing to our already above consensus EPS estimates of 5% growth. So that goes right to where Weiss is talking about. There's a lot of optimism now about the economy, about earnings, multiples being supported. What do you think?
Yeah, so clearly, I agree with Weiss from the fact that we absolutely, for example, the Fed dot plot, is now, the market is now pricing in 150 basis points worth of hikes. The dot plot's at 75 basis points. So we've absolutely seen breadth in the market. Financials are doing well over the last month. Industrials are doing well over the last month. The RSP, the equal weight, is up 8% in the last month. So there is a lot of optimism going forward. And if yields continue to flow down and inflation continues to moderate, the soft landing drum continues to beat higher, that's why I think there's some excitement. But I will say on the other end of it, it's been a lot really quickly. We've moved a lot in the last few weeks, and clearly there's a shift in market sentiment and tone, which I think for me, the most exciting part of the market for me is obviously the breadth, but I still think growth can still play a role in 2024.
How about this, Joe? To Jason's point, financials are up 7% as a group over the past month. Industrial 7, consumer discretionary 7 2/3, materials up 6. Those have been substantial moves to point to the broadening that we've seen, that it's not just tech. In fact, comm services has lagged and technology has lagged as well, and by a reasonably substantial amount.
And there's $6 trillion sitting in money market funds.
Yeah, sitting in cash.
$6 trillion sitting in money market funds when we have had, over the last 90 days, probably the most significant reversal in sentiment that I could remember since 2020 for sure. That reversal in sentiment is certainly going to be the catalyst for a lot of money managers, active and passive, exploring for opportunities in the market. So they're going to go to all the places that you're talking about. They're going to look for where did the market underperform in 2023 as we had this narrow, concentrated performance from the Magnificent Seven. And I don't see how you defeat that positive sentiment just because the calendar turns into 2024, which is what a lot of people are suggesting. So I think you have to be on the offensive as we go into 2024.
Well, you get earnings, though, right? I mean, that's kind of the one thing that's in front of you now, to Weiss's point. You've gotten Powell and company out of the way. You know, you'll get more inflation reads and everything else. But the big event of January is going to be earnings.
Granted, without question, that earnings are the big event, and earnings can moderate some of the positive sentiment in the marketplace. But there's not much else that can do it. And I actually think at the final days of December, where a lot of people are going to say, okay, looks like the year's over, we've seen much of the games, keep your eye on energy, because you have a situation right now in the Red Sea, BP pausing shipments. We know logistically, if you have to go around Africa instead of going through the Red Sea, we know the delays on cargoes. That's what that's going to mean. And you're finally seeing the fundamental effect of what has gone on between Israel and Hamas. Watch energy in the final weeks. There might be still one trade left in the year.